Picture this, there's missiles in the news, oil prices are spiking, your phone is blowing up with notifications, and somewhere between the breaking news alerts and the Twitter threads, someone says, the US and Iran are going to war, and your first instinct isn't to check on your family, it's to open your brokerage app and think, should I pull everything out right now? That's not a bad instinct, that's a human instinct. But here's the truth, the people who act on that instinct almost always lose money. And the people who don't, they usually come out ahead. Today, I'm going to show you exactly what geopolitical conflict does to markets, what smart investors actually do during war scares, and why your biggest enemy right now isn't Iran. It's your own brain. My name is Tom, and I spend way too much time thinking about how to not panic sell during a global crisis. If you're someone who wants to invest smarter when the world feels like it's on fire, hit subscribe and give this video a thumbs up. Let's start with what everyone gets wrong. When war headlines hit, most people do one of two things. They either panic sell everything and wait for the dust to settle, or they go all in on some oil stock they found on Reddit at 2 a.m. Both are reactions. Neither is a strategy. Here's the thing about markets and conflict. They hate uncertainty, but they recover from clarity, even bad clarity. Let's anchor this in real history because your feelings need data right now. During the Gulf War in 1990, the S&P 500 dropped about 20% from peak to trough. Scary, right? But within 12 months of the invasion, it had fully recovered and then kept climbing. During the Iraq War in 2003, markets actually rallied once the invasion began. The uncertainty before the war was worse than the war itself. After 9/11, the single most traumatic geopolitical event in modern U.S. history, the S&P 500 dropped hard in the short term. But 5 years later, markets were significantly higher. The pattern is almost always the same. Fear spikes. Markets dip. Then the world keeps moving, and so do markets. So what does a US-Iran conflict actually mean for your money? Let's break it down by asset class. First, oil. Iran sits on about 9% of the world's proven oil reserves. Any conflict involving Iran almost immediately sends oil prices higher. That's not speculation. That's supply chain math. If you hold energy stocks or oil ETFs, you might see short-term gains. But betting on oil as a crisis play is timing the market. And timing the market is how beginners lose money. Second, stocks broadly. Defense stocks tend to spike during conflict news. Companies in aerospace, weapons manufacturing, and cybersecurity often see short-term bumps. But again, by the time you hear the news, the smart money has already moved. You're not getting ahead of it. You're reacting to it. Third, gold and safe havens. When fear spikes, money flows into gold, treasury bonds, and the US dollar. These are traditional panic assets. They go up when everything feels uncertain, but they also come back down when clarity returns. Here's the uncomfortable truth. None of these short-term moves matter if you're not a professional trader with real-time information and zero emotion. For regular investors, trying to play geopolitical events is like trying to win a poker game where everyone else can see your cards. So what should you actually do? Step 1. Do nothing dramatic. I know that sounds anticlimactic, but do nothing is one of the hardest and most profitable decisions most investors ever make. Selling during a fear spike locks in your losses. Staying invested means you're there for the recovery. And historically, the recovery always comes. Step 2. Check your allocation, not your balance. This is the moment to ask a real question. Not, should I sell? But, is my portfolio built for moments like this? If a 10% market drop makes you physically nauseous, that's not a market problem. That's an allocation problem. Maybe you're holding more risk than you can emotionally handle. Rebalancing toward your actual risk tolerance during a calm period is smart. Rebalancing in a panic is expensive. Step 3. Look for opportunity, not just safety. Conflict creates dips. Dips create entry points. If you've been waiting to invest in a broad index fund, a market pullback caused by fear, not fundamentals, can actually be one of the better times to buy. Warren Buffett didn't build Berkshire Hathaway by selling when headlines got scary. He bought when others were selling. That doesn't mean go all in on day one of a conflict. It means dollar cost averaging. Putting in consistent amounts on a regular schedule works especially well when prices are volatile. Step 4. Separate the noise from the signal. Not every war scare becomes a war. Not every war collapses markets. The news cycle is built to make everything feel like the end of the world because fear keeps you watching. Your financial plan should not be built around what's trending on cable news. Ask yourself one question. Has the long-term earnings power of the American economy changed because of this headline? Usually the honest answer is no. Companies still sell products. People still buy things. Life continues. Let me be honest for a second. The hardest part of investing during scary moments isn't finding the right stock. It's managing the version of yourself that wants to do something, anything, because sitting still feels like losing control. That feeling is real, but acting on it is almost always the wrong move. The investors who build real wealth aren't the ones who predicted every geopolitical event. They're the ones who built a simple system, stayed consistent, and let time do the heavy lifting. Here's your move. If you're feeling anxious right now, open your portfolio. Look at your allocation. Ask yourself if it matches your actual risk tolerance. If it does, close the app and go do something else. If you have cash sitting on the sidelines and you've been waiting for a dip, this might be your moment to start dollar cost averaging into a broad index fund. Not all at once, consistently. And if you're tempted to buy oil stocks or defense plays because the news told you to, wait 48 hours. Most of that impulse will be gone. Comment steady below if you're choosing not to panic. And tell me, what's the hardest part of investing when the world feels unstable? Is it watching the dip? Is it ignoring the headlines? Because you're not alone in this. If you want more strategies for investing when everything feels uncertain, hit subscribe. Because the goal isn't to predict the world, it's to build a plan that survives it.